ಎಲ್ರಿಗೂ ನಮಸ್ಕಾರ. ಡಿಯರ್ ಫ್ರೆಂಡ್ಸ್, ಅಪ್ಡೇಟ್ ಅಕಾಡೆಮಿ ಯೂಟ್ಯೂಬ್ ಚಾನಲ್ಗೆ ಸ್ವಾಗತ. ನಾನು ನಿಮ್ಮ ಮಹಾದೇವ್ ಪ್ರಸಾದ್. ಫ್ರೆಂಡ್ಸ್, ಇವತ್ತಿನ ಸೆಷನಲ್ಲಿ ಅಕೌಂಟಿಂಗ್ ಕಾನ್ಸೆಪ್ಟ್ ಆ್ಯಂಡ್ ಕನ್ವೆನ್ಷನ್ಸ್ ಬಗ್ಗೆ ತುಂಬ ಸಿಂಪಲ್ ಆಗಿ ತಿಳ್ಕೊತಾ ಹೋಗೋಣ. ಸೊ ಲೆಟ್ಸ್ ಸ್ಟಾರ್ಟ್. ಅಕೌಂಟಿಂಗ್ ಕಾನ್ಸೆಪ್ಟ್. ಫ್ರೆಂಡ್ಸ್, ಅಕೌಂಟಿಂಗ್ ಕಾನ್ಸೆಪ್ಟ್ಸ್ ಆರ್ ದಿ ಬೇಸಿಕ್ ಐಡಿಯಾಸ್, assumption, fundamental principles given by GAAP, generally accepted accounting principles. Provide these principle for preparation and maintenance of books of account properly and systematically. So accounting principle play a very significant role for business owners and accountant to understand the basic concept to bring about consistency and uniformity in their accounting process. So it provide all necessary information for maintenance of books of account, properly recording, systematically presentation and report. That's why it play a very significant role. And also these terms help individuals, business and organization systematically recording their financial info there. The first one is business entity concept. Business entity concept is also called as a separate entity concept. So here accountant should treat a business as distinct from its owner. So owners and business are separate. So this concept states that business enterprise is a separate identity apart from its owner. So only here business transactions are to be recorded apart from personal transactions. So personal transactions are not to be recorded here, only business transaction. And also any personal assets are there, like owner's assets or shareholder personal assets are not to be considered here, only a business assets are considered. So recorded only business or properties or assets. That's why business and owners are separate here. So the next concept is a money measurement concept. Money measurement concept holds that the name only give the meaning here. Money measurement. See, in a business, number of transactions are incurred in every day, both the monetary transaction and non-monetary transaction. But business consider only monetary transaction, means it record only a monetary transaction, because monetary transaction only affect the result. That's why monetary transactions are to be recorded in their books. Next concept is cost concept. Cost concept, according to this concept, the various assets acquired by a concern or a firm should be recorded on the basis of actual amount involved or spent. For example, a company purchased a machinery for rupees 5 lakh. So it should be recorded 5 lakh because actual amount spent by the company for purchase the machinery is rupees 5 lakh only. That's why it should be recorded 5 lakh. But this concept is not much relevant for investor, because investor are always interested to knowing what is the actual worth today, business worth today, rather than original cost. That's why it's not relevant for investors. But cost concept says actual amount spent, that amount are to be recorded in books. Next concept, going concern concept. See friends, going concern concept, every business have a long period, because today business is to be established, it is not owned up tomorrow only, it go for a long period. So that financial statement are normally prepared on the assumption of enterprise is going concern, means it will continue in operation for the foreseeable future. That's why every business maintenance or preparation of financial statement on the basis of going one. Next, dual aspect concept, the name only give the meaning. Dual aspect concept means two aspect, means every transaction have a two aspect. Number of transactions are incurred, each and every transactions have a two aspect, two kinds of aspect, both the aspects are effect. That's why both the aspects are to be recorded. Next, realization concept. Realization concept is nothing but when the money is realized, means according to this concept, revenue is recognized only when the sales is made. When sales is made, on that time revenue is recognized, realized, then only books of accounts then only that revenue is to be recorded in books, not any expected one. Expected incomes or gains are not to be recorded, only realized monies are to be recorded. Next concept is accrual concept. Accrual concept means both the revenue and expenses are recorded when it occurred. When the revenue is occurred, when the expenses are to be incurred, okay, on that time only recorded. For example, when payment is received or made, on that time only you guys record the transaction. Means the method follows the matching principle also, which says revenues and expenses should be recognized in the same period revenue and expenses are to be recognized. That time only books of account are in that time only recording the transactions. Next one is accounting period concept. Accounting period concept here, the life of the business is to be segregate or separate or divide in a number of segment, each segment called as an accounting period. Okay, so every accounting period every accounting period presenting the financial data, financial statements are to be presented, means periodical presentation of data, periodically presenting the financial statement. Number of business follow their own nature. For example, some business presentation of books of account periodically, like monthly wise, quarterly wise, half yearly and yearly wise. So that periodical presentation of data is the data is accounting period concept says that presentation of data periodically, it's very important one. Next, the matching concept. Matching concept means both revenue and expenses are to be matched here. Matching principle is an accounting principle for recording both revenue and expenses. It requires business record expenses alongside revenue is earned. So when the business recording the expenses alongside revenue is to be generated, ideally they both fall within the same period, same matched year. Then the next one is objective evidence concept. Objective evidence concept is nothing but every transaction should be in the nature of objectivity, means every transaction must be unbiased and also influence, means internal or external influence, so that each and every transaction based on sources of documents such as cash memo, invoice or sales bill, etc. Number of evidence are there. So each and every transaction must have a documentation, document, source of document. So transactions are to be unbiased, free from influence. Okay, these are all the main accounting concept. Then the next one is accounting conventions. Dear friends, accounting convention is nothing but, of course, it's also a principle. It provides guidelines to an accountant for how the books of accounts are to be maintained, record and presenting the books of account properly and systematically, so that it provides the guidelines to an accountant for systematically recording the business transaction. So there are four kinds of conventions are there. The first one is convention of materiality. Convention of materiality means in a business number of transactions are incurred in every day. All transactions are not a relevant transaction, so number of very important transactions are to be considered. So material aspects are to be considered in for maintenance of books of account, or recording the books of account. So material aspect, relevant and very important one, transactions are to be considered for maintenance of books of account, means at the time of preparation of books of account, recording the relevant information only. So that this concept is very important one. Next, convention of consistency. Consistency means constant in nature, See, books of accounts are to be recorded and properly reported. Number of rules and regulations are to be followed by a businessman or accountant. Accounts are to be reported properly. Maintenance of books of account in this year, the same rules and regulations are carried forward to the next year also. So in accounting, the convention is in consistency in is a principle that the same accounting principle should be used for preparing the financial statement over the number of time period. That's why it's very important one. Next one is convention of conservatism. Convention of conservatism is also called as a doctrine of prudence. Means convention of conservatism states that anticipating all future losses and ignore the gain. When certain period only revenues have to be recognized, recognizing the expenses as soon as possible, so that anticipate all future losses and ignore the gains. And the last but not least, convention of disclosure. Convention of disclosure means full disclosure principle. It refers to this concept suggests that business should be report all the necessary information in their financial statement. So each and every informations are to be provided, each and every informations are there in financial statement, then only that financial statements are very effective, because number of users are there. Number of users refer the financial statement only to know anything. That's why in financial statement each and every informations are available. So this concept holds that every informations are must and should available in financial statement. Okay friends, so these are all the main accounting concept and conventions. Thank you. Bye.